Hi, my name is Greg Durrett, and I thank you for taking a few minutes of your time to take a look at the presentation I've put together called Safe Money for a Secure Retirement, Protecting Your Money for Life. This is something I put together at my office to help folks like you that want a better understanding of how these new products, these new fixed indexed annuities work in today's marketplace. If you're looking for a fancy flash and bang type of presentation, I'm sorry to tell you, this isn't going to be it. But if you do want to find something that can help you understand these products better and give you a better general understanding of how they work in today's market, then this is going to be helpful. So stay with me and let's get on with the show. This presentation has been divided into two parts. This part 1, focuses solely on the structure of the actual fixed indexed annuity itself, whereas part 2 will talk more about the endorsements available, such as the guaranteed lifetime income benefit rider and some of the inflation protection hedges that are contained therein. So let's begin now and start with just what we have here, the fixed indexed annuity structure. First thing I would like to discuss is the myth of living off your interest. It's a wonderful saying that you could work out a 4% rate of return, and then you collect that every year, and therefore your principal will never go down and you can live happily ever after. Well, that's what it says in theory. Average market return, you'll always have an income while maintaining your principal. Well, sounds simple enough, right? Should always work. Well, let's take a look at a hypothetical $100,000 asset earning a 10-year average of 12% gain with a market loss occurring in the first year only and an income of $12,000 per year being withdrawn, meaning that you're withdrawing the interest that you have accumulated on any given year to make sure that that is your lifetime income stream. As you can see, here we have a 10-year average rate of return of 12%. Well, what happened in the first year is we had a 10.5% loss. Don't worry though, we made it up with a 14.5% gain every year thereafter in order to get to that 12% average. Of course, we had to withdraw that $12,000 that we were looking for because that's the income that we were required to have for our retirement. The trouble happens when you take a look at the balance column and you see what has happened with that original $100,000 by the end of 10 years. And that's with only one loss year figured into this 10-year average. It's a pretty daunting thing. Here now are the rates of return required to recover your market losses and the probabilities it would have happened based on a large cap stock market performance since 1946 to 2008. Now, that's not even including what's happened in recent years, but let's just take a look at that large time frame and take a look at the probability since 1946. If you wanted to recover in 1 year, you would have had to have earned a 49.8% rate of return. That happened once in 60 years. So there's a 1.6% chance you're going to recover. If you want to recover over the span of 10 years, you'd need to earn 19.25%. That only happened twice in 50 years. By the way, that's every year. And in 20 years, you'd have to earn 18.2% per year for 20 years. That never happened, folks. Never happened. And that, by the way, is assuming no additional loss years, which has not happened since 1928. What if you moved into small caps? How would your recovery look then? Not so good. The best you could hope for is a 16% chance. What that translates on the other side into is you would have an 84% chance of failure to recover in a one loss year scenario. And we're talking about retirement funds. That's a pretty high level of risk to subject yourself to, considering you don't know how long you're going to live, and the likelihood is you're going to live a long time into retirement. So what can you do? Well, do you want protection of principal? Perhaps reasonable liquidity? Market index growth? Locked in annual gains? Guaranteed interest on your income accounts? Control of your lifetime income protection? I say yes to all of those. However, would you also like some market risk to go along with that? Probably not. So what do? I can tell you how you can get these things without that market risk. The following slide is going to illustrate the function of a fixed indexed annuity in very general terms. Please take a moment to read this slide. We're not going to be deducting for any caps, spreads, or fees, which, by the way, we will discuss, and we'll get into the details of those. But I want you to understand the general functionality of how these work. They're not specific to any one company, to any one product. It is addressing the functionality of the family of products that are fixed indexed annuities. These are not variable annuities. These are not guaranteed multi-year annuities. These are fixed indexed annuities. I want you to understand how they work in a functional way so that then we can go about addressing all the other questions that hopefully you will have after. So how do fixed indexed annuities work? Well, let's assume that we're starting with a hypothetical $100,000 again, and we've started with the S&P index starting at 1,000. We pick an index depending on the company or product. It could be Moody's, it could be Barclays, it could be S&P, it could be all sorts of different ones depending on the carriers. But for simplicity's sake, we're going to use the S&P because most folks are familiar with that. So let's take that 100,000 and go out a year. Most of these products go out on a one-year point-to-point basis for calculations so that we don't have to worry about all the mid-year fluctuations that occur and typically give most folks a heart attack. So for our purposes, let's assume after that one-year period, the S&P went up to 1,100. Again, without deducting for anything like caps or fees or spreads or any of that other stuff that we will discuss in a minute, and not including bonuses, which would have a positive effect on things. We're just going to do pure calculations. So obviously that's a 10% gain. So your $100,000 would now be up to $110,000. So let's take it out to year 2. This is an all too familiar scenario for a lot of folks to see what happens in the market. And here we have year 2 showing a decrease of the S&P down to 500. Well, the number one question you want to know is how much money do you have left after seeing such a precipitous drop in the market? The answer is you still have your $110,000. And that's because we have what's called an annual reset feature built into these products that at the end of any one given year, we lock in your gains, we lock where you are insofar as the index is concerned, and we move forward from there. So while all your peers who are in the market have lost quite a bit of money, you've maintained not only your principal, but your previous year's gain. Year 3 comes along, and all of a sudden we've got a little bit of an uptick, and the S&P went up to 600. Well, that's nice. But most folks are thinking in terms of, what do I have to do to recover? Well, we know that that 600 didn't get you from where you are up to your previous starting point. We know it certainly didn't hit your previous gain, but that doesn't matter because that's a 20% gain over the previous year, and you now have $132,000 in your account. Remember, we annually reset you, and it's not just resetting and locking in your money. We're doing a new starting point at every index point on an every annual basis that you, on your annual anniversary, run into. And we repeat this year after year after year where you are not participating in the downs, but you are participating in the ups. So every time it's down, you're not there. Every time it's up, you're gaining and you're taking advantage of that. And it doesn't matter what year it happens. So long as you are taking advantage of the up years, things are good for you. So now we're into the caps, spreads, participation ratios, and fees. Because everybody wants to know, how does the insurance company make their money? Well, they have different ways of making their money. Typically, one of these will apply to your policy, but there are certain instances where 2 would apply. Let's get into that directly. What are caps? Let's start there. Caps are cap rates that are used to cap the maximum rate of return. So for instance, a cap rate might be, say, 5.5%. So you could earn anything up to that 5.5%. If the market returned 10%, you'd get 5.5%. If the market returned 4%, you would get 4%. If it returned 5.5%, you get 5.5%. It's a way to cap the maximum amount of interest that they would be paying out to you in any one given year. Next would be spreads. The spread ratios allow you and the insurance company to share in the rate of return by allowing the company to earn a percentage off the top of the interest credited. So let's say there's a spread rate of 2%. Well, if the market returned 10 points, the insurance company would take 2 and you would earn 8. One of the questions that always comes up about this particular type of structure is they say, well, what if the market doesn't return anything? What if it's a 0 or a negative or 1%? It doesn't matter. You don't lose any money. They're not going to take money from you until such time as the rate of return exceeds the spread. So if in a 2% spread scenario, you would have to earn 2% to be at 0. If it earned 3%, you'd earn 1. But if it earned 0, they would not take that 2% from you. It's only after the gain exceeds the spread rate that they will then take that and earn that to themselves. So then we have a thing called participation ratios. It's similar to a spread, and you're given a percentage of the total return. Nowadays, you're looking at participation ratios of 25 to 30% of the total gain. That's not very aggressive. In most instances, we're not recommending folks go into that. Once they return to their heyday, the glory days of old where they used to be 80, 90, 100, sometimes 110% participation ratio, then we might recommend them again. So just be wary of products that do offer only participation ratios, as they are fairly low in comparison to the balance of the other options in the market. Fees. This is very important. There are no fees with most fixed indexed annuities. Where there are fees are some of the riders that are available, and some will have fees associated, some won't, but some will. So you may have, let's say, a cap rate of 5.5 and a fee of 0.5% or 0.75% because you added a rider. But the key here is to know that you do not have to add these riders if you don't want, thereby making it impossible for you to pick up these fees that are associated with the riders. So keep in mind, all of these exist. You would have one, say a cap, a spread, or a participation ratio, and possibly plus a fee. You don't have to, but possibly. Why do you need a fixed indexed annuity in your portfolio? Safety and flexibility. Strong written guarantees, not promises, folks. These are written guarantees. Smart money allocations. You can decide how to allocate across a variety of indices so that you can feel comfortable with how your money is going to grow in whatever buckets you chose to put them in. No market risk. I know. Keep singing that mantra, but there is no market risk. Great growth potential in a number of different areas, not only on your real money, not only in your phantom money, but on your income once you finally start taking it. All sorts of different features in order to make sure that the growth is there for you regardless of what stage you are in. And there is a lifetime of inflation-protected income you simply cannot outlive. If you live to 250 years old, that income will continue and will get to you every month, every quarter, every 6 months, every year, whatever mode you choose, to make sure that you can live in the way that has always been the way that you wanted to live. Again, my name is Greg Durrett. The company is Future Secured Financial. We are the future of your protected retirement. This is the conclusion of part 1 of our presentation. If you'd like to continue on, please close here and go to the link for part 2, which will discuss how the Guaranteed Lifetime Income Benefit Riders can provide you with a lifetime of protected income and have it inflation protected along the way. My email and phone number are there for your convenience. Thank you.